Greetings, members, one and all of the Salivation Nation. The stagflation threat is looming, and there's some dates to watch this week for silver and gold. Let's explore! Referencing an article here from bnnbloomberg.ca that talks about this as far as rattling the bond traders for stagflation. Some risk we're taking a look at here as the fog of war continues to descend. It's not working out exactly the way that Putin and Russia had thought. And there is some increased escalation of nuclear options, literal nuclear options. We hear that term and that phrase banted about in congressional hearings and the like, as far as dealing with legislation and the filibuster and that type of thing. But now it's a literal sense that is being bantered about in Russia with Vladimir Putin. And I think that's going to have a great effect on the economy and the perception and the uncertainty that we're seeing. And that is going to play into gold and silver's prices perhaps this week. But the economy is certainly still a front and center thing. Even though we're talking about Russia and Ukraine, that is just another cog in the wheel of an economic complication here. The world's biggest bond market is signaling concern that Russia's invasion of Ukraine could lead to an economic outcome the Federal Reserve is eager to avoid: persistent inflation and weak economic growth. That essentially is stagflation. We can see here in the chart what is showing the 2 to 10 year yield spread, and we can see where it's heading here, and as we move into 2022. Bond market gauges of short-term inflation expectations jumped to a record during the past week as oil and natural gas surged in the unfolding crisis. At the same time, the gap between short and long-term yields narrowed, indicating expectations of an economic slowdown. And as you know, bond yields is another indicator of where gold and silver prices can go. I think only second to, in many instances, at least that we've been able to ascertain as compared to the dollar index itself, which all relates to the fear index too. The dollar index is the main driver here. It's almost as if the fear index is kind of the glue that holds this stuff together, or not. Investors scooped up treasuries that provide protection against inflation, even as traders priced in the Fed will cut rates in 2024, following a series of hikes expected to begin next month. And so that's where that's heading out there. Bank of America Corporation strategists advise clients to start positioning for stagflation, a mix of rising prices and stagnant growth that the U.S. hasn't seen in a generation. The Russia-Ukraine crisis has accelerated the stagflation trend, said Tracy Chen, a portfolio manager at Brandywine Global Investment Management. Higher commodity prices will cause growth to slow down and boost inflation. The Fed will be even further behind the curve. The Treasury market briefly served as a refuge for investors after the Russian invasion, yet stock prices sliding worldwide. Equities rebounded and yields followed suit as anticipation of rising interest rates moved back to the foreground. The benchmark 10-year yield ended the week with just below 2%, near the highs hit earlier this month. Yet 2-year yields jumped even more, narrowing the gap between the two to just under 40 basis points from 45.5 basis points a week earlier. And the coming week will be pivotal for investors seeking to gauge the outcome of the Fed's mid-March meeting, when it is widely expected to start raising its policy rate from near zero, where it's been since early on in the pandemic. Fed Chair Jerome Powell will testify before Congress on Wednesday and Thursday, providing insight before policymakers enter their pre-meeting communications blackout period. On Friday, the Labor Department will release its monthly jobs report, which is expected to show wage pressures accelerated even as payroll growth slowed amid a tight labor market. While the Ukraine crisis led traders to mark down the odds of a half percentage point hike in March, they continue to anticipate a steep but short tightening cycle. The implied yields on euro-dollar futures maturing in 2024 are about 17 basis points lower than those for the 2023 contract, suggesting that traders are pricing in a high probability of a rate cut within 3 years. The takeaway is that inflation will stay elevated, and the expected Fed tightening is going to be the catalyst for slower growth, said Kathy Jones, chief fixed income strategist at Charles Schwab and Company. I won't call it stagflation. Growth isn't stagnant, but is going to slow down. Coupled with the inflation impulse is going to persist for a little longer. Conflict in Ukraine, Europe's largest land war since 1945, threatens to worsen two key points of vulnerability in the post-pandemic global economy: high inflation and jittery markets. That's for sure. They are jittery indeed. The escalation in the conflict sparked a major reversal this week of fortunes for the Treasury-inflated protected securities, known as TIPS, as fears over more price pressures mounted. These securities compensate investors for the hit of inflation and therefore yield less than their plain vanilla Treasury counterparts. The demand for TIPS has faltered in January and early February as Fed officials began to adopt a more hawkish tone. Yet it rebounded after the invasion, with the inrush driving the yield on 5-year TIPS down by as much as 39 basis points on Thursday, touching a negative 1.61%. The yield rebounded to finish the week at around negative 1.2%. Michael Hartnett, chief investment strategist at Bank of America, said the war in Ukraine increases the risk of stagflation and missteps by the Fed. Portfolios should position for stagflation and dollar debasement. In other words, they're not really debasing anything with this dollar, by the way, because there's nothing base about it. There's no precious metals in it. It's essentially cotton fibers in the form of what looks like a piece of paper. In other words, no one really knows the formula from which this dollar is made physically, but we know that it is losing value by design 2% each year and by elevated inflation rates at 7.5%. So that is where we are at, and this is where what we should watch on the economic calendar. We've got tomorrow, Monday, February the 28th, trade balance, wholesale inventories, Chicago producers or PMI, Dallas Fed manufacturing activity. March 1st, we have construction spending, ISM manufacturing data, and vehicle sales data. March the 2nd is the ADP employment numbers and the Fed Beige Book. My guess is the AD employment numbers will probably be good, and we'll see how that plays out. But March 3rd, Challenger job cuts, productivity, and unit labor costs, jobless claims, ISM services, and factory orders. And then finally, we have the employment numbers on March 4th. Looking at the Fed calendar, there will be an event with Atlanta Fed President Raphael Bostic on February the 28th, and then more on the March 1st, and then March 2nd, Fed Chair Powell, Chicago Fed President Charles Evans, and New York Fed Executive Vice President Lori Logan will make statements, and then March 3rd, Powell, New York Fed President John Williams will make their testimony. And we'll see how that plays out. So some things are coming in here in the coming week to see what could potentially move gold and silver prices. One thing for sure, inflation is not going away. We know that. And sooner or later, we should see gold and especially silver react to that. And I believe that silver is going to ride the coattails of gold, outperforming it on the way up, and for those dips on the way down. It's a emotional time in the markets and how they react. They look for any bit of good news, and so they're selling, there's rushing to the safety of cash and that type of thing. We've seen that before, and we see wild movements with these prices for safe haven assets. we'll see how it plays out. But I think one thing for sure, I believe we're going to see higher lows when there are dips in the precious metals, and I believe we'll see higher highs. We kind of almost saw that with gold and silver making its move almost to $26 an ounce during that first day of the invasion. We'll continue to press on. Gold and silver have proven themselves to be the assets that have preserved your wealth over the long period of time. It's a buy and hold situation for gold and silver. There you go. Let me know what your thoughts are in the comment section below. Tonight we do our market watch, so I hope you will join us for that as we take a look and see how markets open up in Asia. From a recent piece that I did, it looks like they're not as affected, so it may be a relatively quiet night. But hey, that's just one angle on this. We shall see how it plays out. I'd like to extend a multitude of gratitude to you all for taking the time to watch, and to encourage you to please rate, share, comment, and subscribe.